Okay. Good morning, students. So today is the lecture part 2. So we are covering the subject strategic financial management, and the topic is foreign exchange and exposure management. In the last lecture, we covered the basic concepts. Okay. Today we'll move forward and we'll have some more basics, but then we will be doing some higher level questions today. So, okay. So let's start. Now, today we are going to talk about interbank rates. The last time I left at this place, okay? So interbank rates basically are wholesale rates. Now, whenever we go to the bank as a customer and we want to buy either dollars or any currency, or we want to sell either as a corporate client or as a traveler. So then the interbank rates are basically the wholesale rates. They are not applicable to the customers, okay, either to the corporate clients usually. So these are basically applicable to the transaction among the banks. So interbank exchange rates are wholesale rates which are applicable only to the banks themselves. So whenever they trade, they use these interbank rates, okay. Now, even the spot rate as well as the forward rate that is available in the interbank cannot be applied to the customer transactions, okay. So the customer transactions rates are little different. So today we are going to understand how to calculate the merchant rates or the customer rates from the interbank exchange rates. And this is very important. So in many questions, so they ask to do this exercise. Okay, this is part of our questions. So now the interbank market is basically a Forex. Interbank market is a wholesale currency arena. So they're all, wholesale transactions happens. This is bank-to-bank transactions which are happening in the interbank market. So interbank market is a global network utilized by financial institutions, bank to trade currencies between themselves. So this is meant for bank-to-bank transactions. So most interbank trading is proprietary, meaning that it may take place on behalf of the bank's own accounts. So, banks are buying and selling the currencies on their own account. But it is also done on the behalf of large customers. Whenever, large customer places an order, so, the banks, they trade to get his order executed to the interbank rates. Okay. So, I'll just skip this slide which we covered last time. Now, exchange rates applicable for transactions between two banks is known as interbank rates. So, this is what we have done. So the exchange rates which are available on the interbank, they are only meant for interbank transactions. Normally interbank rates are quoted up to 4 digits after the decimal. Okay. So it's up to 4 digits after the decimal. And they are rounded off to 4 decimals in the multiples of 0.0025. Okay. So, and I'm going to very soon explain through an example how you convert interbank rate into a merchant bank rate. So this is the screen. On your screen you can see that the interbank rate will have a bid rate as well as the ask rate. So whenever a bank quotes to another bank, so they give a two-way quote, it carries a bid and ask. Then while they quote to the customers, from the bid rate, you have to deduct the margin. Okay. And then you arrive at the merchant rate. Okay. From the ask rate, you have to add the margin. And I'm going to very soon explain through an example why you deduct and add margin to the bid and ask rate to arrive at the merchant bank rate. Okay, fine. So let's take an example here. So I'm going to just note down this example. Okay, though I'll be putting on the screen also. So this example we'll be doing in understanding with the help. How do we arrive the merchant rates by using interbank quotations? Okay, so I'll just give you a half a second or 10 seconds to note it down. Though I'm just also going to put the same on the screen. Okay, so don't worry, I'll be putting this on the screen so you can note it from there. Okay. So I'll just use my board to explain. Okay. Now, so there is a quotation for US dollar which is available. So this is an interbank rate. Okay. So a quotation for US dollar in interbank market is as follows. Okay. So we have the spot rate. Okay. So the spot rate is given as rupees 75.290. So this is the bid rate, and 75.2975. So this is the interbank quote. Okay. Now, it is also given that exchange margin, which the bank charges, is 0.1%. So this is the exchange market, the margin which the bank charges from the customers. Okay. So we have to determine the spot rate for merchant spot rates. Okay. So we have to find out what is the merchant spot rates, or we can say spot rate for merchant customers. So this is the question, and it says that the rate should be rounded off. The rates should be, so this is the question what I'm putting now, should be rounded off in multiples of 0.0025. So this is the question which we are given today. Interbank rates are given. The spot rate interbank rate is, so this is the, basically we can say this is the bid rate and this is the ask rate. Okay. So if you want to buy, or rather if the bank wants to buy from its customer, the rate is 75.29 and the ask rate is, the bank's selling rate is 75.2975. So as I told you, bank buys the currency at a lower rate and sells at a higher rate. Okay, fine. So then the exchange margin of the bank is given, which is 0.1%. Now we have to calculate the merchant rate. The rate should be rounded off in multiples of 0.0025. Okay, so we'll proceed to solve this question now. I hope you have all written this question, but again, if you have not written it, you will get another opportunity. So we put here as bid and ask. Okay. So what is given to us? Interbank rate. Which is the spot rate. Okay. The rate is given as rupees 75.2900. Okay. And the ask rate is 75.2975. Okay. So this is the interbank which has been given to us. And we have been told that exchange margin is in the question it is given that exchange margin is 0.1%. Okay, fine. So what we do is I'm going to first tell you how do we arrive from say interbank rate to merchant rate, and then I'll give you the logic. Okay, so first understand what I'm doing. So the margin has to be deducted from here. We are going to deduct the margin. Why we do it? I'll explain that. Then here we add the margin. Okay, fine. So I'll just do the calculations now. So I say margin. Okay, so I just calculate that using my calculator. So it is 75.29 into 0.1 percentage. So it comes to 0.07529. 0.07529. Okay. Then I am going to minus this. Okay. Minus, so it will be 75.2147. Now, this should be rounded off, okay, in multiples of 0.0025. So I can arrive the date at 75.2150. Okay, so this becomes your merchant rate. So this is just the bid part of it. So now I'm going to calculate here. So I'm going to here add the margin. Okay. So 75.2975 into 0.1%. So it comes to 0.0752975. So 0.0752975. So I can just go on till the last decimal place and add. So this, we get 75.37.372. I rounded off to 28. Though it was coming 279, so I made it 3728. Now, this has also to be rounded off to 0.05 multiple, okay, 25 multiple. So this can be 75.3725. Okay, so I have rounded off to 0.25. Now, this is the merchant rate or the customer rate. So whenever a customer comes, bank is going to offer this rate to him, not this. This is the wholesale rate. Now what bank does, they make profits. So let's understand why we have deducted the margin or added the margin. Okay, let's suppose you are a customer. You go to a bank and you want to buy, say, $1. Or any currency, or suppose in this case, you want to buy $1. So where you will look at? You will look at ask rate. So this is basically so this is bid means buy, ask means sell. So the bank is going to sell you $1 because you're needing $1. So you want to buy it. So you look at the ask rate. Now this is the interbank rate. So they will give you this rate. Okay. Now banks usually don't have dollars with them. They will immediately check the interbank rate. Okay. So because they want to, you want to buy, so they want to sell the dollar to you. So they will look at what rate in the interbank market, the wholesale market, the dollar is trading. So at what rate they can buy for you. So they find it is 75.297. Now, which means they can buy at 75.297. They will not give you at the same rate. They are going to add the margin and give you a price which is higher than this so that they make money. So their cost is this. They are selling at you at this. So the margin is added here. Okay. That's the logic. Fine. Now let's come to the bid rate. Now you as a customer went to the bank and you wanted to sell the dollar. Okay. So you said, I want to sell $1. Now the bank, they can't keep the dollar with themselves. So they will take from you, they'll buy from you and immediately sell it to the interbank market. So they will look at the price in the interbank market. So because they want to sell the dollar. So this is basically the bid price of interbank with the other bank. So at this price, they are going to basically sell the dollar. So they find that they can sell this dollar, which they are going to buy from you at 75.29 paisa. So if you come and say, I want to sell my dollar, so they can't sell at this. Otherwise, they will not be making any profit. So they will be offering a lower quotation. So they will be giving you only 75.2150. The margin is deducted and then they will give you this. So that means you sell to the bank at this rate and the bank will sell the dollar which they have got from you in the interbank market at this rate and make profit out of it. Okay. So hope you understand. Now, it's logic you have understood, but sometimes you may forget the logic. So you must remember that in the bid, you have to minus and in ask, you have to say plus. So it is minus plus game when you are converting the rates from from the interbank market to the merchant rates. So minus is first, plus is second. So means bad news first and good news later. So first minus, then just remember remember this and logic now. If you can apply the logic and find out, it's okay. But if you forget the logic, you can just remember that from the bid rate, you deduct the margin to arrive at the to the merchant rate, and from the interbank rate, you add the margin if it's an ask rate, okay, and then you arrive at this. So I hope you have followed. I'll give you one question which you need to solve it, okay? So are you understanding? Okay, Ranjit, very good. So I'm just going to put a question on the screen now. So this was the last question, okay? So where we have done, on the board we have done it. So is there. Hope you have understood. So now we come to another question which you people are going to do, okay? If there is, please let me know. So this is another example, okay? Fine. So the example is on your screen. I think you can see that. So please let me know the answer. What will be the merchant rates from the interbank rate? So please, okay, sir, okay, so I'm just going to read out your queries. How the bid rate and ask rate can be decided by the authorities. Okay, wonderful. I'll answer it. Sir, for bid we get, sir, why does the bank resell the dollar purchase from us? Okay, very good. So I'll answer all the questions now. Who decides the bid and ask rates? Okay, of course it's the market driven rates, the demand and supply of, the currencies, the dollar, the euro, all demand and supply plays a very important role. And in the interbank markets, these banks are trading among themselves, and they are generating a lot of liquidity and volumes based on, the underlying demand coming from the corporate world, from the government. We are buying oil, we are, exporting. So they are at the same time, people are buying, currencies, and they're selling currencies. So all the market forces decides the bid rate and ask rate. It is not decided by the bank themselves, but it's driven by the demand and supply. And of course, there are certain theories which will be today understanding them. Okay. Sir, why does the bank resell the dollar purchase from us? Now, bank, when they purchase from us the dollar, they can't keep the dollar with them because it's of no use. They have to make money. They're in a money making game. So they will buy from us and resell. Okay. And they want to make a profit because, dollar prices are changing. There's a lot of volatility in the prices which are happening, okay, in all the currencies. So they can't sit with something which they have acquired. They have to sell it immediately and make money. If they keep it and next day they want to sell, or maybe after few days, the rates may change. Okay. And it may go against their, this thing. So the dollar may, instead of appreciating, it may, depreciate, or rupee appreciates for say a couple of days. So they will find that they are into losses. So they don't wait. They will immediately tie up. The moment you go to the bank, they will look at the interbank rate, give you a quote, and they will do the second transaction. If you have bought it, okay, then they will buy it from the interbank rate and sell it to you. If you have sold it, they will sell it back in the interbank market. So they will not hold any stock or any currency stock with them unless you are a Reserve Bank of India. So otherwise you are not going to hold. Okay. So Akansha Jain from Fazilka has answered this question, I believe. Okay. So anybody else? So I'm just going to put the answer here. Okay. Wonderful. I think, Akansha, you've done a great job. Now others can also, Shikhar Rastogi has also done it. Very good. And then Ranjit Mishra has also done it. Very good. I think a lot of people have done it. Arun Barona, 62.6175. Wonderful. Okay. Any other questions? Now, these were very good questions. Why the banks resells and who decides about the bid and ask rates. And as we go along, you'll understand all these things because we are going to discuss, okay, for at least half an hour from now. Up to that, we will be discussing all these things, and then we'll be moving on to all the questions which come into your CA final exams. Okay. Fine. So first, if your basics is clear, then it becomes very easy to solve the question. You will never be stuck up. But if you hurry up and say that I would just solve my CA exam question straight away, then you are going to not land anywhere. If your basics becomes clear, then you can, do it well. And then the job becomes very, very simple for you. Okay. So Shikhar Rastogi has also done very good. So now we move on to some more, conceptual thing, and then I'll explain certain things on the board again. I hope you are able to see the board and So exchange rate determination. So how is exchange rates determined? So somebody asked me that, how are the bid and ask rates are decided. So we are actually moving towards that direction. So exchange rates can be for spot or forward delivery. Either you take a spot transaction or a forward transaction. Either you want it today or you want it, say, after a month or after 2 months. So exchange rates can be for both kind of, quotations. The spot rate is a rate paid for delivery within 2 days, business days, after the day the transaction takes place. So you buy in the spot market, the delivery happens within 2 days. So that is T plus 2. Okay. So the transaction day plus 2 days when you will get the delivery, or the delivery will be taken from you. If you're selling the currency, like you have to, give the currency to the dealer, or if you are buying, you will get your delivery after 2 days. Now, if the rate is quoted for a delivery of foreign currency at some future date, it is called the forward rate. Now, if suppose you say that I want my dollar on 1st of November and the rate is decided today, so then it is called the forward rate. In the forward rate, the exchange rate is established at the time of the contract. Okay. So when you enter into a contract with a bank, you say that I want my dollars or euros or Japanese yen or Swiss francs, whatever, in the month of, say, on 1st November. So they will give you the rate today. Okay. For the rate which will be applicable on 1st of November. Okay. So the rate will be freeze for you. Though the payment and delivery are not required until maturity. So that means you don't have to make any payment. Okay. And there will be no delivery given to you at the time. Only it will be done. The payment and delivery will happen only on 1st of November. If you are known to the bank, a big customer, so bank will, just note down your request. Maybe you have to submit some form and it will be end of the story. And you come on 1st November, they will be ready with your delivery, or you have to give the delivery to them. So forward rates are usually quoted for a fixed period of 30 days, 60 days, 90 days, 100 days. So you say, I want to buy a dollar or euro after 30 days, after 60 days, or after 90 days. Okay. So then, or 180 days. So the forward rates can be given in these kinds of fixed duration. So there are some more questions coming in from Devija. Sir, how to round off? Okay. So I'll explain that. So once more, I'll do one more question later on where I'll tell you how to round off. Okay. So forward market. Forward exchange rate occurs when buyers and sellers of currencies agree to deliver the currency at some future date. Okay. Self-explanatory, which I have already explained. Nothing new. They agreed to transact a specific amount of currency at a specific rate at a specified future date. So if I go to a bank as a corporate client, no, I say I require $10,000. Okay. On 1st of November. Of course, the banks will be giving me the rate. It will be at 75 rupees, say 30 paisa. So this agreement takes place, immediately. The forward exchange rate is set and agreed by the parties. Fine. Now, when we go to the bank, they will give me a rate. If I'm a large client, we can always negotiate. Okay. It will all depend on whatever the interbank rate which is prevailing in the market. Or if it's a very, very large order, then the bank can, go to the interbank on my behalf and, negotiate there. And remains fixed for the contract period regardless of the fluctuation in the spot exchange rate. Now, suppose I bought the dollar today, to be delivered on 1st of November. Okay. And the rate is fixed today, which is 75 rupees, 30 paisa. Now, whatever happens in the spot market, even if the rate goes to 80 rupees, I will get, my rate will be 75 rupees, 30 paisa. So that's the beauty, because then I am actually away from that exposure risk of, the foreign exchange, appreciating, the dollar appreciating in suppose I am an importer. So then I am going to lose. So my rate is fixed today, which is 75 rupees, 30 paisa. Whatever happens in the spot rate, it is of no concern of mine. I will get my dollar at the rate which is fixed today. Okay. If it goes up, it's my good luck that I'll be getting. But if it goes down, then definitely, I have to still pay. But since I'm doing business and my main concern is of business and not to look at the volatility of the market. So, and I have fixed my, selling prices based on my costing. So I'll be happy that whatever rate the bank has fixed, it is actually giving me a profit. So even if it goes up and down, so it gives me a peace of mind that this is my rate. Okay. So forward exchange contract implies a forward delivery at a specified future date of one currency for a specified amount of another currency. So this is a somewhat repetition. Sir, will you cover study material question? Yes, I'll be covering. Akansha, I told you that I'll be covering all the questions from the study material, most of them, but you have to just wait for some time because you are still in the process of, building up the understanding about the subject. Okay. So maybe in half an hour's time, we'll be on the study material questions. Okay. The exchange rate is agreed today, though the actual transactions of buying and selling is taking place on the specified date only. So these are, self-explanatory. So a currency forward contract. A currency forward is a binding contract in foreign exchange market that locks in the exchange rate for purchase or sale of a currency in future days. So this example I just gave you. A currency forward is essentially a customized. Now this is very, very important. Please note a point. Okay. Okay. So, Chala, I'll give you some circumstances. Okay. A currency forward is essentially a customizable hedging tool that does not involve any upfront margin payment. So it's a customizable hedging tool. Now, if I have to, go to the market, so I have two choices, okay? A forward market or a futures market. In the forward market, I can always customize, it's a customized hedging tool. Suppose I want, say, $10,500 on, say, 1st of November. So bank can always entertain me. But if I go to a stock exchange, then there are lot sizes. It's a standard market where a lot size of dollar is, say, 1,000. So I have to actually go in multiples of $1,000. Here, whatever may be my exposure, say $10,356, so I can go to the bank and enter into a transaction for such an odd amount. Okay. But you can't do that in a futures market. And there is no margin charged in the forward market. Whereas in the foreign exchange, in the futures market, you have to pay a margin. Okay. Now, the other major benefit of this is very, very important, so please note down. The other major benefit of currency forward is that the terms are not standardized and can be tailored to a particular amount and for any maturity or delivery period, unlike the exchange traded futures. Now, I told you that there are two options, to achieve the same thing. Suppose you want to, hedge your currency risk. Either you go in the forward market or you go in the futures market. In the forward market, you can tailor-made your, request. Okay. In a futures market, it's a standard market. Okay. I'm going to explain that in more detail with example later on. So there in exchange, you have to pay the exchange margin. Okay. Upfront margin you have to pay. Then it is in multiples of certain dollar, like $1,000 is one lot. Okay. Suppose you have $75,800 exposure. Now, in forward market, you can go and the bank will give you a contract for $75,800. But if you go to the stock exchange in the futures, you will get either 75,000 or 76,000 because it has to be in multiples of $1,000. Okay. So more explanation later on. So forward contracts, now we are coming to an example so that you understand that forward contracts are usually offered by commercial banks. So banks offer their important customers forward contracts as part of their business. So it enables the firms to engage in international trade with limited exposure to foreign currency risk. So basically, what is the, idea behind this, or what is the benefit? It enables the firms to engage in international trade with a limited exposure to foreign currency risk. Basically, it helps you to avoid the currency risk. Okay, you pass on that risk to the bank. Fine. So we'll learn that through an example. Okay. So let's go to the exchange rate determination. Fine. Okay. So before we touch some study material questions, so let's understand some theories. So somebody asked me how the exchange rates are determined. Who decides the bid rate? Who decides the ask rates? Okay. So there are a couple of theories, okay, which are there, which offer some explanation. Now the oldest theory is a mint parity theory. Mint means gold coin. Okay. Now this theory is gone. Okay. Where the price, the foreign exchange quotation was decided on the basis of the gold price. Suppose the gold price in Britain is, say, 20 pounds per ounce. Okay. In India, we talk about grams or tola. So in ounce is about 28.5 grams. Okay. So $2.8 thereabout. So Great Britain, the price of, gold is say 20 pounds, and in US it is 80 pounds. So that means 1 pound will be equal to $4. My screen is not full. Okay. The second is the purchasing power parity theory. Can you see my screen now? Sunny Purva? So the second theory is basically the purchasing power parity theory, which is the exchange rate is determined on the basis of inflation prevailing in one country, okay, over the other country. For example, if suppose the price of a computer is $500 in US, okay, in New York, and the same computer costs 2,500 Hong Kong dollars in Hong Kong, then the rate should be $1 equal to 5 Hong Kong dollars. So these are the two theories first which came, and the third theory is called the international Fisher effect theory. Okay, fine. So I'll come to this international Fisher effect theory before that I'll explain the interest parity theory. Very, very important. Most of your questions in your study material will be containing these types of questions. So please understand, after we understand this theory, we'll be moving on to study material questions very shortly. So interest parity theory says that there is a strong relationship between interest rate and movement in the currency values. So it says that interest rate and the foreign currency rates have a very strong relationship. Okay. Suppose, let's take an example. If suppose US interest rate is 2% per annum and India it is 6% per annum, and if the spot rate now is 70 rupees per dollar, so forward rate should be 70 into 1.04, okay, 1.04, which is the differential between 6 and 2. So the forward rate should be 72.80 paisa per dollar. Okay. So this is what the interest parity theory says, that the difference between the two interest rates will actually prevail, and the spot rate and the forward rate will be decided based on. So the currency which is having a lower interest rate will have a premium, and the currency which is having a higher interest rate will trade at discount. So this is what this theory says. Okay. Now, the international Fisher effect theory also says the same, but it says that the future interest rates decides the exchange rates, not the current rates. Okay. So you can read this more about, but this is talking about the same thing, but in a different fashion. Okay. So, just two more slides and we'll be doing a question. Okay. So what is the interest parity theory? It's very, very interesting. So please, focus. If this is very clear, I think you can solve many of the questions of yours, okay? So what is interest parity? So we're going to do only interest parity theory in detail, and there will be some 5 or 6 questions which have been there in our study material. We'll attend that. But before we do that, we must know what is interest parity theory. So interest rate parity theory is, which states that size of the forward premium or discount shall be equal to the interest rate differential between the two countries of the concern. So we have seen that example, okay? And we'll see it again. If 1 year interest rate in US is 2% and that in India it is 6%, then the US dollar would trade at 4% premium against the rupee. So the text is not visible. Okay. So I'll make the text a little bolder. Okay. Don't worry. I'll just do that. When the interest rate parity exists, can you hear me properly? Is it? Okay. So when the interest rate parity exists, covered interest arbitrage is not feasible. Okay. So this is very important. When the interest rate parity exists, so there is no arbitrage which can happen in the market. Okay. So we'll understand what is this arbitrage. Because any interest rate advantage in the foreign country will be offset by the discount on the forward rate. Now, for example, let's say the rate of interest in India is 6% and in US it is 2%. Then people will like to put money in India because it is giving 6%.
Parvesh sir. Parvesh sir. Parvesh sir.
Hello.
Sir, I think your screen hello. Your screen is not that much visible.
Kyun?
So I can no. If it is okay, I think you should switch off the camera just one time. Then screen will be fully visible.
अच्छा switch off करूँ camera?
Students are just switch on of the camera. Then share the screen. Then it will be clear to student because it is font is not clear.
Okay, I just
Now share the screen, sir.
That's why I was asking. Okay, can you see it?
Yeah. Now it is clear.
Okay. So just keep
1
it
minute.
back. 1 minute. Okay. ओके लेकिन वो फिर दिक्कत हो जाएगी बोर्ड पे अब इसको बंद करता हूं कैमरा को क्या करूं
No, sir. Okay, ठीक है सर. Continue, sir.
Okay. So now I think you can see my screen. So I'll just read about this. What is interest rate parity theory? Okay. So this is very important theory because many of the questions which have been set in the exams in your study material they are from this interest parity theory. So please understand this very carefully, and after you have understood this, we will be moving towards the study material questions. Okay. So interest rate theory states that now I'm just giving you an example. If 1 year interest rate in US is 2% and India it is 6%, then US dollar should trade at a 4% premium against the rupee. Fine. So the currency which is having a lower interest rate should be always trading at a premium against the country which has a higher rate of interest. So in this case, where the rate of interest is 2% in America and India is 6%, then the 1 year forward rate of dollar will have a premium of 4%. Okay. Now, if this theory is actually in reality played out in reality, then there is no business of arbitrage. Then there will be no arbitrage which can happen. Okay. Otherwise, if the US is not trading at 4% premium, then the arbitrageurs will set in the market. Okay, they will come into the market, and then we'll find very soon, after a couple of days or a couple of seconds or a couple of minutes, the interest parity theory will play out in reality. Now, suppose when the interest rate parity theory exists, covered interest arbitrage is not feasible. So that means nobody can do arbitrage. Okay, if it is fully playing out. Because any interest rate advantage in foreign currency will be offset by the discount in the forward rate. Now, I was giving you an example. Now, in India you get 6% rate of interest. In America you get 2%. So a lot of Americans would like to put their money in India to earn 6%. So if you bring the dollar into India and it gives you a 6% return, when you take it back, you will lose 4% on account of the currency depreciation. That means our currency, Indian currency, will depreciate by 4%. So in fact, you are still getting 2% return on your dollar. So if that is the case, there is no arbitrage which can happen. Okay. But in case if the Indian currency has not depreciated to the extent of 4%, say it has depreciated less, 3%, or it has depreciated say more than 4%, then the arbitrage will happen in the market. Okay. Fine. So okay. So there is a question first, and then we will be doing an example and then some study material questions. So according to the interest parity condition, if the domestic interest rate is 12% and the foreign interest rate is 10%, then the expected now read out all the options A, B, C. I hope you can all see that. Okay. So tell me which is the right option. Okay. I'll just wait for your answers. So which currency will appreciate, okay? So there are 4 options given to you, and you have to choose the right one and answer me. Okay, so Vijay Kumar from Nepal, wonderful. The answer is B. Okay, you have given the right answer. Okay, so now, okay, so we are doing now covered interest rate arbitrage, and we do a question on that. Okay, so covered interest arbitrage has an advantage, as there is an incentive to invest in higher interest currency to the point where the discount of that currency in the forward market is less than the interest. Now, there can be two scenarios. Either the currency has not depreciated to the fullest extent. That means that if the rate of interest is 6%, in America it is 2%. So our currency should depreciate by 4%. So if it has not happened, then there is an arbitrage which can happen. Okay, so let me just explain that through an example. So I'm just, putting my camera on again. Okay, so I'm just going to the board. Suppose we take the same example that 1 year interest rate is given to you, say in US and India. Okay, so in US it is 2% and in India it is 6%. Suppose this is the 1 year interest rate which are given to you. Okay, so we know that US would trade at a premium of 4% premium against the rupee. So that means US should trade at premium. At the rate of 4%. So that means US currency should trade at a premium of 4% against India for 1 year rate. Okay. Now suppose $1 is equal to rupees 70. So this is your spot rate. Okay, so this is your spot rate. Now 1 year forward rate. Please calculate 1 year forward rate and let me know what should be the 1 year forward rate as per the interest rate parity theory. So how much should be the dollar? Give me the rate. Anybody? I'll just wait for your answers. So what should be the rupee look like after 1 year? If the interest parity theory is really playing out in reality, okay, what should be the rate after 1 year? So please give me your answer. So what should it be? Tell me. I'm just waiting for the second figure. So if the spot rate is of $1 is 70, interest rate in US is 2%, India is 6%. So that means US should be trading at 4% premium, okay, against the Indian rupee down the line 1 year. So what should be the rate of dollar after 1 year? What should be the rate of the 1 year forward rate today? Suppose you go to the bank and say, I want to buy a dollar today, so they'll say 70 bucks. If you say that I want to buy my dollar after 1 year, tell me the rate today. So what rate they are going to give you? Okay, 72.75. 72 point, round it off to 80. So I have got the right answer from many of you. Okay, wonderful. Ambika, Shatrughan, Krishan, and Ranjit, you have answered it. Okay, so this is the rate. Okay, fine. And how we arrive at? So we said 70 into 1.04. The rate interest rate differential, we got 72.80. So this is very simple. Okay. Now, this is called, if suppose this is the rate given by the bank, then this is called no arbitrage price. this is a no arbitrage price. That means no arbitrage can take place. So arbitrageurs cannot come to the market. Now, in every market, there are three kinds of players, okay? One are basically the hedgers, who are either importers, exporters, so they have an interest in the market because they have some currency transaction which they have done, either import, export. The second people are called the speculators, who are going to only speculate and make money because of speculation. If the rate goes up and they have taken a wrong position, they're going to make money, so they are called speculators. The third variety of people are arbitrageurs. They only see the mispricing of the rates. Okay, if they find that the spot rate and there is a mispricing between the spot rate and the forward rate, then they are going to come to the market and do their arbitrage trade. So this is called no arbitrage price. Okay. Now let's say that if this price is not there, okay, it is not coming out to 72. Okay, if the 1 year forward rate is rate other than 72 rupee 80 paisa, then the arbitrage opportunity comes in. Suppose it is say 73 rupees, okay, or 72 rupees 50 paisa. Okay, if this is the situation, you can go to the bank and bank says that forward rate is 72 rupees 50 paisa per dollar, or say 73, then there is an arbitrage comes into play. Okay, because this is not exactly gelling with the interest rate parity theory. So let's understand that. So remember this rate. Okay, so this rate should be, but suppose the rate is 72.50. Let's say this rate is 72.50. Okay, so $1 is equal to. So you go to the bank and bank says that they can give a forward contract to buy the dollar at 72.50. So the arbitrage opportunity will be occurring. So what the arbitrager will be doing? Okay, so let's understand that. So what we'll do, because at $1 72.50, so this is a 1 year forward rate, okay, 1 year forward rate. Since our currency has not depreciated by 4%, so the depreciation is less than the 4%, okay. So that means it will be people from US will start putting money in India because they will be making a earning, or you will be actually, what you will be doing. First step, what an arbitrager will be doing, so money will start flow into India, okay, in form of dollars. So you will borrow dollars, okay, either you are Indian or an American, you are going to borrow dollar at 2%, okay, because US the rate of interest is 2%, so you can borrow the dollars at 2%, okay. Fine. Suppose you borrow, say, dollar. So spot rate was $70. Okay, we know that. So you got $1 into India. Okay. Then you do the second thing is that you are going to enter into a contract. Okay, converting US dollar at set today, entering into a forward contract. So first you are going to do is you borrow dollars, then convert dollars into rupees. So you borrow dollars, you bring the dollars in India, convert that into rupees, and you invest in India at 6%. Fine. At the same time, you are going to book a forward contract. Book a forward contract. 1 year forward contract. Okay. 1 year contract. What is the rate? 72.50. So what will you be doing? The first thing you will be doing will be, you will be borrowing US dollar at 2%. Second, you convert this dollar into Indian rupees. Okay, fine. So it will become 70 rupees for you. Okay. Then invest that at 6% in India because you get 6% return. But at the same time, on the same day, when you do all these things are done on the same day, you book a forward contract because you want to take back. Suppose you are an American, you are going to take back your dollar back after 1 year to your home country. So you booked it today you got it at 70, you are taking your money at 72.50. Okay. So let's say what is the gain? So all this, what he has done, he will be gaining 0.43%. I'll just write it again. So because of this, he is going to gain how much? 0.43. I'll show you a calculation. So this will be the arbitrage gain to the guy. So this is a sure shot. All these things have been done on the day one itself, and he knows that he's going to make a 0.43% return on whatever investment he has made. Whether it is $1 lakh or $10 lakh or $5,000, he's going to make 0.43% of profit. So let's say how it has been done. So how this profit has been worked out? So what is the arbitrage profit? It's very simple. Arbitrage profit. First, you have borrowed in US dollar, you are going to pay 2% money to the bank in America. 2% is the cost of borrowing. Cost of borrowing dollars. So this is the money which has gone from you. Then when you are taking your money back, the Indian currency has depreciated from 70 to 72.5. So which means that you will be taking lesser money in terms of dollars. So you will be taking a hit of 3.57%. I'll explain you how it has been worked out. So this is basically, if you look at 72.5 minus 70 divided by 70. So this was the spot rate, this is the spot rate, this is the forward rate. You will find and multiply by 100. So you will get 3.57%. Okay. So this 3.57% is actually from the dollar point of view. Okay. He is losing money. Okay. 3.57% because he brought the dollar at 70. He is taking his dollar back. Okay, at 72.50. So he got $1 when he borrowed $1 in America. When he's taking this money back, he'll be getting less than $1 with the same price. So he loses 3.57%. But he will be making a gain of 6% interest on the money which he has invested in India. Okay, so this is basically the interest which is earned on lending. On lending or investing the money in India. So if we just total it up, so this is 5.57 minus 6, so this gives you 0.43% gain. Okay, I'll just explain that again. So arbitrage profit 2% because he has borrowed money in US dollar, he is going to pay 2% rate of interest. Then he is going to lose on account of the rupee depreciating against the dollar. Okay, of course, rupee has, the dollar has appreciated against the rupee, but it has depreciated against, the rupee has depreciated against the dollar. So he is going to lose out in terms, because your money is invested in India in rupees, so you lose out on depreciation. Okay, so 0.357% you are going to lose out. Then you are going to gain 6%. The interest which you will be earning in India on the rupee which you have put in India. So the arbitrage gain will be 0.43%. I hope you have understood this. So we are not saying 6 months forward, it's a 1 year forward rate, okay? Fine. So there was a query, so we find 6% forward rate, we will be, okay, we are not saying 6 months, it's a 1 year forward rate, okay? Fine. So let's now talk about the reverse arbitrage. Now, if it trades higher than set, now we know that the spot rate, I'll just explain again the spot rate and this thing. Today the spot rate is, dollar is equal to rupees 70. So this is the spot rate. Okay. $1 is equal to, so we are talking about 1 year forward. 1 year forward rate. Okay. So this should be 72.80, but suppose it happens to be 73. As per the interest rate parity theory, it should be 72 rupees 80 paisa. But assume that it is 73 rupees. Okay. Now, since it has depreciated more than 4%, so there is a arbitrage opportunity. It is called reverse arbitrage. Okay. Now, instead of borrowing money in US, you are going to borrow money in India. Okay. So you borrow in INR, Indian rupees, at 6% per annum. Okay. Then you borrow money in INR. Okay. Suppose you borrow, say, 70 rupees. Then you convert that into US dollars. Okay. So borrow INR at 6%, converting rupee into USD at rupees 70. Okay. And entering into a forward contract. So what you do is, again, you convert rupees into dollars. Okay. At the rate rupees 70, which is the spot rate. Okay. Then you invest dollar in USA at 2%. Okay, fine. Okay. And at the same time, you are going to enter into a forward contract because you have taken the money in USA. So after 1 year, you have to bring the rupee back in India. Okay, so that you know how much you have gained or lost. So you convert your dollars at forward exchange rate of 73. Okay, fine. So when you took out the money, you took at 70 rupees. Okay, and fine. So this is what you have done. So let's see. So you borrowed at 6%. That means there is a 6% cost to you. You converted that. Then you had actually invested that money at 2% there. Okay, and your 70 rupees has become now 73 rupees after 1 year. Okay, so this is your, I'll just write it here. This is your dollar. Okay, and after 1 year, suppose you took the dollar 1 year back. Okay, you borrowed dollars. Borrowed Indian INR and converted into dollar. So you had dollar 1 year before. Now you still have $1. Suppose you are not put it anywhere. So it will become from 70 to 73. So there is a gain, there is an appreciation which has taken place by just keeping the dollar with you. But since you have invested, you will be getting 2% return more. So the return between 73 minus 70 comes out to be how much? It comes out to, let me just check. .28%. So which is nothing but 73 minus 70 divided by 73 or 70. Let's just calculate here. 73 minus 70 divided by 70. Okay, into 100. So you will get 4.28%. Okay. So let me just check. 73 minus 70 divided by 70. So it comes to into 100. So you get 4.28% gain. So which means you have got a gain of 4.28%. So what is your gain? 4.28 plus 2, 6.28 minus 6. So your net gain is plus 0.28. Okay, fine. So this is called the reverse arbitrage. So in case if the rupee is not working out as per the interest arbitrage theory or interest parity theory as 72, then you may have either the normal arbitrage or the reverse arbitrage depending upon how far the currency has depreciated or appreciated against it. Okay, so I'll just show you this on the screen now. Okay, can you see the screen now? Okay. So I'm just showing the screen to you. Okay. Okay. So can you see the screen? Plus, please read out from the screen. Okay. And I'll just then move to the second part of it. Now there are certain questions which have come from, say, Chala Purushottam. Sir, please explain the reason for US trading at 4% premium in our example. Now, you know, if the interest rate in say India is 6% and in America is 2%, the US currency will trade at a 4% premium. Okay. Now everything is linked actually to the inflation. Okay. So, because of inflation, the prices of the commodities change in India. Okay. And again, the interest rates are also dependent on the inflation prevailing in the country. So, the countries which are having low interest rates will always trade at a premium against the countries which have a higher interest rates. Okay. Okay. So, Kishan, I told you, just see the screen, okay, 4.28%, okay. So, if you see, Kishan, it is, there on the screen, at the bottom of the screen, it is 73, you know, the current rate is 73, you had a dollar at 70, okay. Then now it is 73, so you have gained 3 rupees because you have invested your money in dollar. After 1 year, you are taking, the dollar will appreciate by 3 rupees. So you will gain in 3 rupees. Okay. And, that works out to be 4.28%. So what you are doing is that, you are, in this game, what you are doing by borrowing in INR at 6%, converting the rupee into USD at 70. Okay. So you are borrowing in India and, converting the borrowing into US dollar at 70 rupees. Okay. That means suppose you have borrowed 70 rupees in India. So how much dollars you will get? $1. You take that dollar and keep it with you. After 1 year, it is worth 73 rupees. Okay. Suppose you even don't invest anywhere. Suppose you bring that dollar back to India after 1 year. How much you are going to get? 73 rupees. If the interest parity theory plays out, the spot rate would exactly match with the forward rate. And you will get a 73 bucks. Okay. Or you enter into a forward contract. You will get 73 itself because in this, example, what you have done, immediately you have taken a forward cover for 1 year where the forward rate of US dollar was 73. So your $1, which was 70 bucks, has equal to now 73. So you have gained 3 rupees over 70 rupees. So if you do your math, then you have gained about 4.28%. But since you have borrowed the money in India, you are paying 6% interest rate and you have put that money, which was in dollar in US at 2%. So that means you are paying 6%, you are getting 2% and 4.25% as depreciation. So the transaction would result in an arbitrage profit of 0.28%. Since the interest of 3 on 70 1 year is equivalent to 4.8%. So this is basically on the screen. You can just, Kishan, can you read on the screen on the right hand side? The explanation is given to you. Okay. So arbitrage profit is 0.28%. So you, borrowed money, in rupees. So you have to pay 6% to the bank. Okay. From where you borrowed the money. And then you are going to gain because of, the dollar has appreciated 4.28%. When you bring back, you convert your INR since you have borrowed, you have taken the money to USA, you are converting back into Indian rupees. So you will get 73 rupees. So you took 70 rupees out and you are bringing it 73 rupees in. So 3 rupees you are gaining because of this transaction. Plus, you are going to, since you are going to put that dollar into work in America at 2%, so you are going to gain 2%. So your arbitrage profit will be 0.28%. I hope you have followed it. So now, when is the condition when the arbitrage happens and when the reverse arbitrage happens? In arbitrage happens if the Indian rupee has not fully depreciated. Now we know that the currency should have depreciated by 4% because the interest rate differential was 4%. India, the interest rate is 6%. In America, it is 2%. So our currency should have depreciated by 4%. Suppose it has depreciated by 3%. Then you can do the arbitrage. That means you borrow money in US dollar and invest in India. You will make money. But if the Indian currency has depreciated more than the interest rate differential, suppose it has depreciated by say 5%, then the reverse arbitrage comes into play. Okay? So then you will actually borrow in India and take the money in America in dollar form and invest there. Okay? At the same time, you book a forward cover to bring the money back to India. In whole process, you are going to make money. Okay? Because of excess depreciation which has taken place, not because of the interest rate, which is 4%. So it is 5%. Yeah, we will be considering the bank rates. Okay? Fine. So let's understand, and then now we'll do some questions. First question from the study material we are about today. Okay? So according to the interest parity theory, the forward rates are dependent on the prevailing interest rate in two countries. Okay? The forward rate can be calculated by following formula. So this is the formula which is there on your screen. Okay? Fine. Which says F divided by S, where F is the forward rate, which you want to know. S is the current spot rate, is equal to 1 plus the interest rate in the home currency, RH, divided by 1 plus RF, that is the interest rate prevailing in the foreign currency. Okay, so this is the formula what we use to arrive at the forward rates as per the interest parity theory. Okay, fine. So now we will be doing some questions, okay, from the study material. Okay, so now we move on. All our focus will be on the questions which are coming in your past exam. But before we do that, let's do an MCQ. Okay. Okay. So the first question is on your screen. Okay. Fine. So look at this question. In the interbank market, spot rate is 75.59 oblique 6900 per US dollar and exchange margin is 0.10. Then the spot merchant rates are likely to be without rounding off. So let me know what would be the merchant rates. A, B, C or D. So just calculate the merchant rates and let me know which is the right option. So the first MCQ talks about the interbank rates are given and you have to calculate the merchant rates. The exchange margin is given. Okay. You don't have to round it off. Okay. So give me your answers without rounding off. Okay. In the meantime, I'll just look at your queries here. So Chala has asked the question, please explain me the reason for 4% premium in America. Yeah, definitely. Because happens mainly because, India is a country where, the inflations are very high. So our prices keep rising. Okay. Fine. As compared to America where the price rise is very less. So if the dollar rupee remains the same, then actually the dollar will lose its value. So just that, the $1 purchasing power remains same, our rupee depreciates. And again, the inflation rate is basically dependent upon, is the deciding factor of the interest rate. So that's why we look at the interest rate, okay, as per the interest rate theory. Or we can even look at the inflation rates to decide the thing. Sir, we find 6 months forward rate will be 70 into 1.4. No, it's not 0.5. It is actually, I've said it is 1 year. So don't write minus 0.5, okay? Ayushi? Okay. Then let me say, okay, so answer 1A. So A is the answer which has been given by Ranjit Mishra and Rahul Barona as well as Arun Barona. Answer is A, okay? Okay, so the answer is A. Sir, what is the difference between mirage and reverse arbitrage? It's not mirage, it is arbitrage and reverse arbitrage. Okay, so before I answer this, I think some of you guys have given the right answer. So this is the right answer. So Kishan, I'll just try to explain again. The arbitrage happens when the currency has not fully depreciated. Okay. In our example, the depreciation was only 3.5% or 3.57%. As against 4% it should happen. So the arbitrage will happen. But if in the case, if our currency has depreciated more than the US, more than 4%, then the reverse arbitrage will happen. In the normal arbitrage, we will borrow in dollars and invest in India, okay, and take that money back, convert that money back into dollars. You will gain in the process because the depreciation has not happened fully. So you will get the interest rate differential in your favor. But in case if the currency has depreciated more than what it should have, then the reverse arbitrage happens. Then in that case, you will borrow Indian rupees and pay the interest rate in India and invest that money in US and interest earned there, and you get even the advantage of the higher currency depreciation. So that means your dollars will become more in terms of rupee than what it should have been. It should have been only 72.80, but it is 73. So you are gaining, okay? Because what dollar you brought, you are converting that money back at 73. So your dollar is equivalent to now 73 against 70, which is much more than the interest rate differential it should have allowed. So that is the reverse arbitrage. Okay. So, okay, the option A is correct. Sunil has also given okay, no problem. The answer is D you have given, but it is actually A. Okay. Then Aniruddha has also given answer A. Okay. So, come to the question number 2. Okay. Hedging is used by corporates to choose the right option and tell me which is the right option. So after the MCQ, we will be start doing some questions from your study material, past exams. So it will take a couple of minutes before we move on to the questions from the study material. So now the question 2 is, hedging is used by corporates. Hedging means you are taking a forward, you are looking at the forward rate and booking your order at that price. Okay. So I gave you an example. Suppose you book the dollar today, say at after 1 year at 72.80. Today the dollar is 70, and you expect to make a payment to a supplier at 72.80. Okay. So then you know that you are going to make a payment at 72.80 after 1 year. But suppose 1 year's spot rate is 75, so you lose out money. Okay. If you have not taken a forward contract. So while you take a forward cover, you are hedging yourself. Okay. So against which kind of risk? Decrease in the variability of the cash flows, decrease in the variability of the income tax paid, increase the variability of the income tax paid, increase the variability of the forecasted fund flows. So the answer is D, decrease the variability of the, SP from Tamil Nadu, the answer is correct. Answer is A, to decrease the variability of the expected cash flows. Not the B, nothing to do with the income tax rates here. Okay. Fine. So the answer is, hedging is done to decrease the variability of the cash flows. Because otherwise your cash will get affected. Okay. Because you bought something at 70 and you have to make the payment say after 1 month and the rate goes to 72. So you have to pay 2 rupees extra. You have a extra cash outflow. But if you book the contract today, say at 70 rupees 10 paisa, then you are decreasing the variability of the expected cash flows in the future. Which of the following is not a type of the foreign exchange exposure? So this is out of your earlier knowledge, which you have, studied. So you have the economic exposure, you have the translation exposure, the transaction exposure, income. So which of the following is not due to the foreign exchange? Okay. So there are 4 options, A, B, C, D. Which of the following is not a type of the foreign exchange exposure? So use your sense and give me an answer. Is it because of the economic, you can be affected by the foreign exchange exposure, or it can be, translation exposure. That is when you can convert your balance sheet items, the foreign currency items into Indian rupees. So you can either gain or lose in terms of translating your loans or your assets. Or the transaction exposure, which we are talking about, your answer is D. Yes, the answer is D, right. Answer is D. Okay. Now, 4th. Okay. If the price on the future date is higher, then the currency is said to be at forward premium or forward discount. Okay. 4th question. If the price on the future date is higher, then the currency is said to be at. So which is the option? A or B? If the price on a future date is higher, then the currency is said to be at premium or discount. Can I have answers from you, please? So the 4th MCQ talks about if the price on a future date is higher, then the currency is said to be at a forward premium or discount. So if it is higher, then we say it is at the forward premium. Okay, fine. So answer is premium. Then we go to the 5th one. Forward premium. So I think most of you have replied 4th is A. Yeah, absolutely. Forward premium, forward premium. Wonderful, wonderful. I think most of you have replied it correct. Okay. Now we come to the MCQ number 5. If the forward rate is less than the existing spot rate, it contains a discount or a premium. Pretty simple. So for MCQ number 5, what would be your response? So it is number 5, okay? So MCQ, if the forward rate is less than the existing spot rate, it contains a discount or a premium. So what is your response? So I'll just wait for your response. I think people might have responded by now. So the answer is discount. Okay. So let's go to the question number 6 now. And I'll wait for your responses for question number 5. I haven't got it yet. The currency which carries lower interest rate is always at dash versus the other currencies at a premium or discount. So this is question number 6. The currency which carries a lower interest rate is always at premium or discount versus the other currency. So the currency, yeah, 6A, yeah, it's a premium. Very good. 6th B, somebody has written, no. A is the right answer. Most of you have given the right. Okay. Now let's do some more and then we'll move on to the question. Interbank rates are dash dash which are applicable to transaction among wholesale banks. Interbank exchange rates are wholesale rates which are applicable to transaction among banks, or retail rates applicable among retail customers, wholesale rates and customers, wholesale rates and merchants. So tell me what is the right answer. So Shatrughan, you have given the right answer. Vijay, you have given the right answer. Ranjit has also given the right answer. Harshita has said count, which is wrong. And Salim has given the right answer. Okay, fine. Okay, so the question number 7. Interbank exchange rates are wholesale rates or retail rates, okay, which are applicable among whom? Okay, so I wait for your response now. The interbank exchange rates are what? Wholesale rates or retail rates, which are applicable to transaction among whom? The retail customers, banks or merchants. So what is the right reply? So let me know. So 7, what's the answer? Okay. 7th, the answer is A. Absolutely right. I think most of you have given the right answer. A. I'm seeing all over the screen. It's A. So A is the right answer. Okay. So now we move on to a question. Okay. Coming from the study material, we'll go back to the MCQ a little later now. Okay. So we do our first question from the study material. Okay. So I'll be moving on to the board, but before I do that, I'll be putting that question on your screen. Now you can open up your exercise material which you have downloaded from the institute site. So this is the question what I'll be doing. Okay. So I'll be stopping the screen now. So this is your exercise number 1. Okay, fine. So the question says on 1st April, 3 months interest rate in UK and US are 7.5% and 3.5% per annum respectively. And the rate between UK and US dollar is given as 0.7570. Okay. What would be the forward rate for US dollar on delivery 30th June? Okay, fine. So let's just put down some facts here. So we are given 3 months interest rate. 3 months. 3 months interest rate. Between UK and US. So UK and US. So in UK, it is 7.5%, and in US it is given 3.5%. Now, according to you, which currency should trade at premium? The US should be trading at premium because it is having a lower interest rate, and UK the interest rate is 7.5%. So, okay, so he's not asking that, but it is given that the rate is given that $1 is equal to pound 0.7570. Okay. Now we have written this. Okay, $1 is equal to pound 7.7570. But in our question it is given UK pound oblique US dollar. Spot rate is 0.7570. So how do we know that this means this? This is a very important, question or very important learning. How do we know that? There is no standard convention of writing the course. Okay? And you have to apply sometimes your common sense to do that. Now, $1 US is 0.7570. That means $1 US is equal to 0.75. Now look at some rates in India. Okay, $1 is equal to rupees 75. So this is the current rate of interest rate. 1 pound is equal to rupees 95. Okay. So if you are aware of the current rate, some of the rates which are there in India, just remember some of them and you can always know what this currency is. Now, dollar is 75 rupees, pound is 95. So that means $1 should be, your pound is greater, so when $1 you will get lesser pound because pound is 95 and dollar is 75. So this is one way of understanding that what this quote means. Okay, you must apply this sense that this quotation means $1, but because if you say 1 pound is equal to how many dollar, it will be actually the reverse of it. Okay, so you will get more dollars because dollar you will get more. Okay, because so you will get $1.32. I have done a reciprocation of it. So 1 divided by 0.75. So 1 pound is equal to $1. Remember here, 75, 95. So that means in pounds you will get more dollars. But $1 you will get less pound. So if you are aware of the current, position, okay, because the dollar has remained between 50 rupees or 45 to 75 and the pound has remained between say 75 to 100 in the last 7 or 8 years. So even if you have to put, sometimes people put wrong. They say 1 pound is equal to $0.7. So that would be wrong way. Okay. So you must use your common sense that $1 should be equal to, because there is no standard convention which is there. So people can write the way they want. Okay. In some countries people use this way to write, and so this means $1. So this means $1 is equal to so many pounds. Okay. Okay. So these are the tips you should remember all the time. Okay? How to read a quotation. So now coming back to the question. UK, the interest rate is 7.5. In US, it is 3.5. So this is the spot rate which is given to us. And we are supposed to find the forward rate. Forward rate, what is the forward rate for delivery on 30th June? What is the forward rate of dollar of delivery on 30th June? So today is what? Today is 1st April. So this was 1st April. So we have April, 1st April. Then we have May, okay, then we have June. So this is, if we take this April to June, that means we're talking about 3 months. So between April to 30th June, April, May, June, so there he's talking about 30 days forward rate. So we need to find a 30 days for 3 months forward days rate. So we use the formula, okay. So if you remember, the formula is F divided by S is equal to 1 plus RH, 1 plus RF. So here, forward rate, which we need to find out, spot rate is given here, okay, and now this is your home currency. I told you, if you look at the currency, this is your home currency and this is your foreign currency. So this rate is given and on the right hand side you will have the home currency. So this is the home currency. So that means H will be this way and F will be this way. Okay, so let's solve it. So it will be F divided by 0.7570 pound. Okay, I can just forget to write pound at the moment while solving, but I've still written it. Or rather I can avoid that. So 1 plus 7.5 percentage. I can write like this also. Okay, percentage. So this is for 3 months. So I divide it by 4. Okay. Then divided by 1 plus 3.5 percentage divided by 4. Okay. So I can close the bracket. So I just solve this. Okay. So this I can write as 1 plus 0.075 also like this divided by 4. Fine. 0.01875. Okay. Then 0.035 divided by 4 plus 1. So I get 1.00875. Okay. Fine. So this is equivalent to this. So then I say F is equal to 0.7570. I just take it to this thing multiplied by I'll just solve it this 1.01875 divided by 1.00875. So I got 1.009913. Okay, so this is what I'm getting. So I just multiply this by 0.7570. So this comes to, so forward rate comes to 0.7645. Fine. And this will be $1 is equal to so many pounds. So this is the 6 months forward rate. Okay. So just have a look. So this is a pretty simple question. So have you all followed? Okay, fine. So this is given in your question, okay, 0.7570. So I'm just checking. Okay, the forward rate is 0.7645. Yeah, absolutely right, Ranjit. Ayushi, you have also done right 7645. It should be 0.78. So please look at the answer here. Okay, so this is the way we have done it. Okay, fine. So now I move into the second question. Okay, I'll just start this off. We move to the second exercise. So one more question and then we are going to have a break. Okay. So this is a pretty simple question. I think you can solve this question yourself. So the rate of inflation in India is given as 8%. Okay, per annum. This is per annum. And the rate, and in US it is how much? 4% per annum. Okay. The current spot rate, that means $1 is equal to rupees 46. So this is given, this is a spot rate. Fine. So the current spot rate for US dollar is 46. What will be the expected rate after 1 year and 4 years applying the purchasing parity theory? So it says that what will be the 1 year forward rate and also the 4 year forward rate. Okay, using purchasing parity theory. Okay, so this is the question which is there. Okay, so now we will be solving this question. So we know that the current spot rate is rupees 46. So we will use the same formula which we use for interest parity theory. Okay, 1.08. Now this is per annum. So this is going to be 1 year rate. Okay, 1 year forward rate which we are trying to calculate. So 1 year forward rate. So it will be 46 into 1.08 divided by 1.04. And we will get a 1 year forward rate. Okay. So 1.08 divided by 1.04 multiplied by 46. So we get rupees 47. Rupees 47.77. Okay, fine. So this is the 1 year forward rate. We have used the same formula. Okay, so the forward rate F is equal to the spot rate multiplied by interest of the home currency divided by interest of the foreign currency. So India, the rate is 8%, and we have the quote which is in order. This is the home currency, so this will come here, and this is the foreign currency will come here. Fine. So this is the home currency which will come on the top, and the foreign currency. Okay. So similarly, we can calculate a 2-year rate, a 3-year rate, and a 4-year rate by simply doing 46. Now we will take 47.77, this figure, multiplied by 1.08 divided by 1.04. So we solve this, you get rupees 49.61. And similarly for the third year, the rate will be rupees 49.61 into 1.08 divided by 1.04. So solve this and you will get answer as rupees 51.52. So now let me know what is the 4th year rate. Okay. After that we'll head for the break. Yes, Nina from Delhi has given the answer as 53 rupees 50 paisa. So that is the right answer. So others also please do that. So the answer is 53 rupees 50 paisa. Okay, fine. So can you just give me the answers, some of them in 1 minute, and then we'll go for a break and come back at 8:45. So what is the rate for the 4th year? Please give your answers, some of you. So we are heading for a break. Okay, Sneha has given the right answer, 53.50. Sahil is 53. Wonderful, wonderful. Everybody seems to have given the right answer. Okay. Yeah. So you can also use this. What you have written, Krishna, you are right. We can also use this instead of calculating like this. The 4th year rate we can also calculate. Like this. Rupees 46 into 1.08 raised to 4. 1.04 raised to 4. So the 4th year, if you solve this, you will get 53 rupees. 0.50. So instead of taking a long cut, you can always use and calculate the 4th year rate by 1.08 raised to power 4. So that means 1.08 multiplied by 4 times divided by 1.04 multiplied by 4 times. Solving it and multiplying by 46, we get 53.50. So your answer is right. Okay, so we have a break now. So we will come after 5 minutes. So 8:46 we meet again. Thank you very much. अच्छा मैंने कैमरा हटा दिया है नहीं मैंने वेब कैमरा हटा दिया जो लैपटॉप का कैमरा है उससे आ रहा है ये बेटर है हाँ
Okay. So now, we just lost the connection a bit. Now there is an MCQ number 8 which is there on your screen. Please try to answer this. Okay. The spot rate is a rate paid for delivery within dash business days after the day the transaction takes place. So can you answer this? This is your MCQ, question number 8, which says that spot rate is a rate paid for delivery within how many days? 2 days, 3 days, 1 day, 7 days, after the date the transaction takes place. So can you give me the right answer, please? I'm waiting for your answer for the MCQ number 8, which is there on your screen, which gives 4 options. So you have to choose the right option and tell me which is the right option. Okay, so now I've got, it's 2, 2, 2. Yeah, everybody has given the right answer. Okay. So now, we just move back to our question, study material question one more. Okay. So, I'm just going to do the exercise number 3, I believe. So I'll just see which is the question which we are doing. So I'm just, moving on to the questions from the study material. Okay, so we'll talk about the question here. So which is exercise number 3. Okay, so please open your exercise number 3. Okay, so exercise number 3. So this is what we are doing. Okay, the present interest rate for 6 months borrowing in India is 9% per annum, and the corresponding rate in US is 2% per annum, and US dollar is selling in India at 64 rupee 50 paisa per dollar. Then will the dollar be at premium or at discount in the Indian forward market? Okay, so now looking at this question, tell me whatever you have studied today, whether US dollar will be at premium or at discount compared to the Indian currency in the forward market. So please give me your answers on your chat line. Okay. Okay, fine. Second question, find out the expected 6 months forward rate for US dollar in India. So this also now you can do. So we have solved 2 questions already. Find out the rate of forward premium / discount. Okay. So this is the question. Okay. Where the couple of things which are given are borrowing, 6 months borrowing in India. So 6 months borrowing rate is given. In India. So in the meantime, I'm just writing some of the facts on the board. Please try to solve and give me your answers. Okay. And the corresponding borrowing rate in USA is how much? Is 2%. Okay. This is per annum rate. Okay. Fine. And it is given that $1 is equal to rupees 64.50. Okay. So this is what is given, and first question is whether US dollar will be at premium or discount. Please tell me whether the US dollar will be at premium or discount. So the
be premium and the forward rate is 66.74 and premium is 6.95%. Okay, so this is first reply I have got. Anybody else? So the answer I checked, the answer is 66.74. You're right. And rate of premium is 6.94. And then we have, okay, so let's do this question, okay? Let's solve this question now. Now we know F upon S equal to, so this is basically the spot rate is given to us, so we can just simply replace the spot rate, 64.50, okay? I'll use the other pen, is equal to, now I have to write the rate of interest. So it is, India it is 9%, okay? So it will be 0.09 divided by 2, okay? Upon 1 plus rate of interest is, married is 2%, so this is, okay? So when I solve all this, okay, this I can write as 1.045, okay, fine, divided by 1.01. Okay, so once I solve this, I get forward rate as 64.50 multiplied by, say, this number. So, which is, I just use my calculator, 1.045 divided by 1.01. So I get 1.034 something, okay, into 64.5. So I get 66 rupees 74 paisa. Okay, so that means the forward rate is 66 rupees 74 paisa. So that means $1 is rupees 66.74. Okay, this is the forward rate which is going to be there. Okay, fine. So this the question asked me to calculate the forward rate, 6 months forward rate. So this is a 6 month forward rate. So this is a 6 months forward rate. Okay. Then we have to find, so what is the percentage of premium or discount? Okay. So we know the rate of premium we can calculate. Say we have got the rate as 66 forward rate 66.74 and the rate which was there earlier was 64 rupees 50 paisa, the spot rate, divided by the spot rate 64.50, okay, multiplied by, say, 6 months rate, so I can do it 12 by 6 multiplied by 100, okay. So I can calculate this comes to 6.94% premium. So this is the premium. So that means the dollar is at premium, which is at the rate of 6.94%. Okay. I hope. Okay, we can do that. There's no issue. So can we create a WhatsApp group for all our fellow students? Okay, so we'll let you know.
Pravesh sir.
Anji.
Sir, we cannot form any group like that.
I know. That's why I am just telling that we need to check that. Okay. I know. We can't.
We cannot create. Okay. Whatever with the query of the students, they can email at us.
CASU. Yeah, they will route it from the CASU. Yeah. So you can, if you have any query or anything, you can send it to the Institute of Chartered Accountants, okay, and they will forward it to me and I'll answer in the next class. Fine, so don't worry about that. So I have got replies from most of you and they are all correct, okay. So we have done this question. Now we come to another question, exercise number 4. So let's do it, okay. So let's do some more questions from the study material. Let's move to the more tougher questions now, okay. Now we move on to exercise 4. So this is a very, very interesting question and it revolves around the arbitrage which we did in the morning, okay. So this will help you out. to understand, because now you know what is arbitrage. Okay. So following are the spot exchange rates quoted at 3 different foreign exchange markets. So there are some spot exchange rates which are given in different foreign exchange markets. USD INR is given as 48.30 in Mumbai. So that means $1 is equal to 48 rupees 30 paisa in Mumbai. In London, 1 pound is trading at 77 rupees 52 paisa. So that is in London. And in New York, 1 pound is trading at $1.6231. So that is 3 quotations which have been given. Okay. So the arbitrager has US dollars, either 100 million we can say or 1 crore, assuming that there are no transaction cost. Explain whether there is any arbitrage gain possible from the quoted spot exchange rates. So please have a clear look on the question. And the question says there are 3 spot exchange rates which are given, and there is an arbitrager who has 1 crore US dollars with him, and we are assuming that there are no transaction cost involved in carrying out the transaction in these markets. Okay. Whether there is any arbitrage gain possible from the quoted spot exchange. So a very interesting question. So how do we solve it? Let's understand. Now we know that it is given that $1 is equal to rupees 48.30 in Mumbai. Okay. So I'll use a different pen. So $1 is given. So this is in Mumbai. Okay. So let us find out the same rupee is quoted for how many dollars abroad. Okay. If it is more or less, then only the arbitrage is possible. If it is expensive or cheaper abroad, then we can say there is an arbitrage. So let's understand. Now in your question, what is given is that 1 pound, we'll write pound as GBP, 1 Great Britain pound is equal to rupees 77.52. So that is as per the question. Second, it is given that 1 GBP, or you can say GBP1, okay, whatever way you want to write, is equal to US dollars. USD, how much? 1.6231. Okay, so these 2 things are given to me. This is actually given in London and this is in New York. Okay, fine. So I can just use these 2 quotations and write this way. USD 1.6231 is equal to rupees 77.52. Isn't it? So this is a common factor. So US dollar is equal to 77.52. Now, which means 1 US dollar is equal to rupees 77.52 divided by 1.6231. Okay. So we'll do that. So let's calculate. 77.52 divided by 1.6231. So I get 47.76. So this is $1 is equal to rupees. So which means dollar out of India is trading at 47.76, whereas in India it is trading at 48.3. So that is, there is a mispricing between Indian market and abroad. So arbitrage is possible. Okay. So the question said, first of all, the first question was, the arbitrager has $1 crore. Assuming there is no transaction cost, explain whether there is an arbitrage gain possible from the quoted spot rates. So let's understand whether there is a gain or loss. Okay. So dollar is expensive in India. We know that. So we'll buy dollar in India and sell abroad. So this should be a strategy that we will buy dollar in India and sell it abroad. So let's do that. So arbitrager can proceed like this. So he can, convert his US dollars. So he has got how much money? USD as 1, and how many zeros there? 3 to 5 to 7 zeros. So this much of money he has got. Okay. So we know that $1 is equal to rupees 48.30. So I can straight away apply, because $1 is 48. So 1 crore D of dollar would be equivalent to how much? This multiplied by 48.3. So this money will become very big, 48 crores 30 lakhs. Hope I am putting all the zeros properly. Okay. So this money will be there. So there will be 1, 2, 3, 2, 5, 6 zeros. Yeah. So this money is there. So this is crore. So 48 crore 30 lakh rupees we have. So what he has done, basically, he has converted his dollars into Indian rupees. Now he goes abroad and buys dollars from there. How will he do that? He is going to first convert this into pounds. Okay, because we have the pound code. Okay. So we know that 1 GBP is given as rupees 77.52. Okay, fine. So 1 Great Britain is equal to 77.52, but we have rupees. Okay. Okay. So we have a rupees here. I'll just write it properly. So this is in rupees. Okay. Now we want to convert this into Great Britain pounds. So we need the code in order. So we need a rupee code. Okay. So what we'll do, we can just simply do is that we can take this amount, 48 crores, and multiply this by 1 divided by 77.52. Or I can straight away divide by 77 points. So this, we are reciprocating the code and calculating 1 rupee is equal to how many pounds, okay, or how many Great Britain. So then I can just simply multiply. Okay. So that's what I have done. I have got rupees now, and I am multiplying with the inverse code. Okay, fine. So my answer will be in pounds. Okay, fine. So it will be how many pounds? It will be GBP. So I'll use my calculator. 48, 1, 2, 3 divided by 77.52. So I get 62 lakhs 30,000 623065. Okay, 0.155 pounds. So I have got 62 lakh 30,650 pounds. Okay, so I will just rub from here and solve the rest of the portion here. Okay. So now I have got these many pounds. Now I am going to convert these pounds into dollar, and let's see how many dollars I get. Okay, and we know that the code is given that 1 Great Britain pound is equal to how many dollars? It is given 1.623. 1.6231. So I have got pounds, so I can just simply multiply them here with this amount 6230650.155. So my answer will be in dollars. Okay, so it will give me the answer in dollars, which will be 10112. I can use the calculator, okay, to calculate it. So 62, 30, 650.155, okay, multiplied by 1.6231. So we'll have 10112968, okay. Fine. So this will be 101 12,000. So that means I have more than 1 crore dollars. I had $1 crore initially, now it has become 1 crore, 1,12,968. Okay. So I had, in India, I had got $1, okay, $1 crore. Now by doing this arbitrage, the difference of this will be my gain, which will be 1,12,968. So this is my gain. So my gain is, arbitrage gain is, I am writing it back, $1.112,968. So this is his gain. So let's see the question again, what he says. The arbitrager has $1 crore, assuming that there are no transaction costs. Explain whether there is any arbitrage gain. Yes, there is a gain from the quoted spot exchange. Yes, there is a gain. How much? 1 crore, 1,12,968. I hope you have understood this. So let's see any queries you have. So gain is 1,12,968. Wonderful. I mean, Anushka Jain has given the right answer. Shikhar Rastogi, profit using arbitrage. Akansha Jain, sir, can we calculate in terms of GBP? Yes, you can do so, but the answer should be in actually dollars, because you want to know how many dollars you are going to get. Okay, fine. So it will be always better to, in terms of dollars, you should calculate your profit, but then you have to convert that into, another thing. Okay. So ideally way would be to in terms of dollars. Okay. So I think most of you have understood this question very well. Okay. So people have answered. So let's go to another question. Okay. So exercise number 5. So we go to exercise number 5 and let's read out the question. Spot rate $1 is rupees 48.0123. 180 days forward rate is given as $1, rupees 48.8190. So we have, the spot rate given for dollar, and forward rate for dollar is given also for 180 days, which is 48.81. So that means the dollar is appreciating. Fine. So in terms of the forward rate, the annualized interest rate for 6 months rupees 12%. Annualized interest rate for 6 months is US dollar is 8%. Is there any arbitrage possibility? If yes, how an arbitrager can take advantage of the situation? If he is willing to borrow 40 lakh rupees or US dollar 83,312. So the question is there with you. Okay. So I'll just write some of the facts of the question. So we are given the spot rate as $1 is equal to 48. So this is the spot rate which has been given, and then 180 days forward rate is also given, which is $1 is equal to rupees. So please, while I am writing the question, please try to solve this question yourself. It's very easy. Whatever I explained under the arbitrage, understanding concept, it actually fits into that. So it's a very simple question. Okay, 48.8190. Okay. So we have the spot rate, we have the 180 days forward rate. Now we know that the interest rate in rupee interest rate, I am just writing in shortcut, is 12% per annum. So that means in India, the interest rate is 12% per annum, and in US, it is 8% per annum. Okay. So this small information is given to you, and you have to work out whether there is any arbitrage possible. Please explain the logic to find out the route for arbitrage gain. Okay, so I'll explain that while I explain the question. So tell me, okay, I'll explain that. I think many of the students can do it themselves. See, look at the two quotes, okay, fine, and see that what is the kind of a gain, how much rupee is appreciating against the dollar, or how much, dollar is appreciating against the rupee, okay. So let's do that. So we know that it is forward minus spot divided by forward into 360 divided by number of days into 100%. Okay, or rather, sorry, it's other way around. It is days divided by 360. Okay, fine. So I'm just going to cut this and write straight away. So we know that forward rate is 48.8190 minus forward rate minus the spot rate 48.0123 and divided this by the spot rate, which is 48.0123. Okay. Now this is for 180 days. That means 6 months. So I can multiply this by 12 divided by 6 and multiply by 100. The space is just there, so I run there. And try to calculate what is the premium of dollar. Okay. So we'll do that on a calculator. So 48.8189 48.0123 divided by 48.0123, okay, into 12 divided by 6. Okay, so I get 3.36. 3.36%. So this is, the dollar is trading at 3.36 premium, isn't it? So this is the premium. Now, if you look at the interest rate differential, it is 4%. So that means the dollar should have appreciated by 4%, but it has appreciated only by 3.36. So the arbitrage will happen because the interest parity theory is not playing out in the forward market. Okay, so it is not actually, the Indian rupee has not depreciated to the extent of 4%. It has depreciated to the extent of 3.36%. So what will happen? You invest your money in dollars. Okay, fine. So let's understand what will happen. So you are going to borrow dollars, okay, and bring that money in India, and at the same time take a forward cover to convert your dollars back at 48.81 and invest those dollars in India and earn the rate of interest of India, which is given there, and you will find that you are in profits. Okay, so let's do that. So in this case, since the depreciation has not happened fully, okay, so we will borrow. Instead of borrowing rupees, we are going to borrow in US dollars. Okay, so we are going to borrow dollars. How much? 83,312. For how many months? For 180 days. That means for 6 months. So that is what I am going to do. Okay. So which means that I am going to pay interest. Okay. The American rate of interest is how much? Let me just check. It is 8%. Okay. So that means this 83,000 I have to pay back after 1 year is 1.08, okay, into 6 by 12, a half a year. So that means this amount will become, I have to return how much? 86,644. So I can just use a calculator to arrive at. So yeah, 1.08. So I have 86,444. So this is the money which I need to give it back. Okay, after 6 months in form of dollars. So if I borrow US dollar in America and I will be charged 8% interest rate for half a year, so that means I have to repay back 86,444 in terms of dollar. Okay, fine. Now, what I do, this is the same money I am going to convert this in Indian rupees, in INR, at spot. That is 48.013. Okay, 48.0123. Because I have borrowed dollars, I am going to bring that money in India and invest in India. So I am going to convert this into rupees. So which will give me 40 lakh rupees. Okay. So this is basically 83,312, 83,312 multiplied by 48.0123. So I get 40,000 rupees. So this figure is in rupees. Okay, fine. Now I am going to put this money at interest. Okay, so how much interest you get in India by putting your money in India? Let's check in the question. It is written as 12%. So 12% is for 1 year. So I am going to put it for 6 months. So which means I am going to earn 40 lakh rupees. Okay, into 1.06. So if I make it half, okay, fine. So it will become 42 lakh 40,000. So this money will grow to 42 lakh 40,000. Okay, fine. Then what I am going to do is I am going to, at the time when I brought my dollars into India, I booked a forward contract to convert my rupees into dollars at 48 after 1 year. So I am going to convert this back into dollar and repay my loan. Okay, so this I have done 6 months earlier itself, on the day when I borrowed dollars. So I am going to now convert this rupees into dollars. Okay, fine. So 40 to 40. So what I am going to do is I am going to, so this is in rupees. So I am going to 42 lakh 40,000. I am going to divide this by 48 or reciprocate the code to arrive at the right code and then convert that into dollars. So I will have now 86,000. So I'll just calculate 42 divided by 48.8190. So I have 86,851.43 dollars. Okay, so I have got this much amount, 86,851.43 dollars. And how many dollars I was supposed to pay? So I have got this much dollars. So this is my gain. So 86,851.43. This is, I've got the money when I converted my rupees after it has earned the interest at 6%, okay, or 12% per annum and 6% for half year. So, and then converted that money back into dollars at the forward rate. So these many dollars I have got. Okay, but then I have to pay I have to repay my loan. Okay, so what is that amount? $644.00 dollars. So that means I have got more dollars and less of my liability. Okay, so I will be making again 86,851.43 minus 86,644. So the gain will be $206.6.43. So this is the gain what I am getting. I'll just recalculate. 86, 851 minus 86. Oh. So I have got roughly got these. Okay. So this is my gain. Fine. So in terms of I can convert that into spot rate and find out what is my gain in rupees. If I do that, it will become rupees 10,103. So this needs to be multiplied by 48.0123. Fine. So this is the gain. As of now, I believe I'll be getting as per the spot rates. Hope you have understood. So your gain is 206.43. Oh yeah, 206.95 is the right one. Okay. Maybe I have made some calculation mistake. So Shikhar Rastogi, your answer is absolutely right. 206.95. Okay, Dhruva, you're getting a gain of 207.4. Okay, there can be rounding of errors, so it's okay. And 3.36% is basically the premium on dollar. Okay, as per the forward contract, you're also right. So, okay. So I think most of you are giving the right answers and you have understood the concept. Okay. So now let's do some kind of some more MCQs now. Okay. Fine. It's a time that you answer some of the questions which I'm going to put to you. So I'm just going to share a slide on the screen. Okay, so I think last time we just lost the connection. So this was the question which were, will there be class tomorrow? No, there will be class day after tomorrow. That's the first. How to decide which country should we borrow? That's a very good question. How to decide which country we should borrow? Now, it all depends upon, how the currency has depreciated. I think you were not present in my earlier part of the lecture. Like if the depreciation has not happened to the fullest, okay, then you borrow in the country where the higher rate interest is there. Like, if the Indian currency should have depreciated by say 4%, which is the interest rate differential between India and US, assuming that the interest rate in India is 6% and in America it's say 2%. Suppose this is the example. Suppose the interest rate in India is 6% and America is 2%. So that means Indian currency should depreciate by 4%. Or the dollar should appreciate by 4%. But suppose the depreciation doesn't happen by 4% of the Indian rupee, it happens less. Then we should borrow in India. Then we should actually, borrow US dollars and invest in India. Because in India you are going to gain more because the depreciation has not happened to the full extent. So you should borrow in US dollars and invest in India. But if it is the other way around, then you should borrow Indian rupees and invest in US dollars. If the depreciation is more than 4%, going by our example. Okay. Suppose the depreciation is 5%, then borrow in dollars and invest in India. If the depreciation is less, that means borrow in India and invest abroad. You will make money. Okay. Okay. So now we have the question number on your screen. Which is a MCQ. Can you all see that screen? Okay. So please try to reply. I hope, Kishan, you have got your answer. Okay. Please look at my earlier slide. You will be able to do. So how do we choose whether to borrow in India or US? Was it simply because borrowing rate was lower in US, or do we consider? So I told you that. I just, offered this explanation to Kishan. I'll again do it after some time. Let me just complete some of the MCQs. I'll come back to you, Shikhar. So, Vikas Gupta, answer is A, 2 days. Yes, absolutely right. So let's go to now, MCQ number. Yeah, answer is 2. So I think most of you are right. So let's come to the question number 9. Okay. Shikhar, I'll answer your question again, though I have already answered Kishan. Have you listened to my reply which I gave to Kishan? Or should I repeat it again? So please look at on your screen, there is MCQ number 9 which has come on the screen. Please read and try to fill in the blanks from the options which are given on your screen. Is the option A? Is the option B? Is the option C? Is the option D? The major benefit of the currency forward is that the terms are not standardized, because only the standardization happens in the futures market. There the lot date, lot size is decided, the maturity day is decided, the day of final settlement decided by the stock exchanges. Okay. Whereas in a forward contract, you can, you have your own maturity date, you can have your own, number of dollars you want to take a forward cover. So there is no standardization, and they can be tailor made as per your requirement. So the option number A is the right option. It's a very, very important MCQ. If you understand this, then you understand the difference between the what is the tailor mean? Tailor means, you go to the tailor and you have your shirt as per your size. So here the tailor means that you go to the bank and say that I'm going to receive $1,10,325. I want to, I'm going to receive this money, say after 3 months. So I want what rate you're going to offer to me. Okay. He is going to give the date. So the bank is going to accept that they are going to convert my dollars into a fixed exchange rate. Okay. So everything can be tailored according to your own, the amount, the foreign exchange rate, the day, everything can be as per your choice. Okay. Whereas in case of futures, they are fixed rules. Okay. You can, take a position in the futures market on only a standardized term of the stock exchanges. Okay. You can do it in terms of $1,000 per lot. Okay. Suppose you have $10,000, so that means you have to buy 10 lots in the futures market. Okay. But if you have some odd amount, then you can't do that. So either you will be remaining underexposed or overexposed, okay, in the market. So you can't hedge your currency 100%. So that's the advantage you have in the forward market. So you can tailor your own requirement. You can give to the bank and bank will. And in the futures market, there are daily settlements and monthly settlements happening. Okay. Whereas in this, you will have your settlement as per your choice, because you want your dollars to be delivered if you are an importer on a particular day. So the bank will do that. Okay. And similarly, if you are an exporter, you want your dollars to be purchased by the bank at a certain rate on a certain date. So that can also be, given by the bank. But that flexibility is not possible in the futures market. In the futures market, you have to pay in margin money. Here you don't have to pay at all. Okay. Fine. But there are benefits of the futures market, but that we'll discuss when we do the futures. Question number 9 is A. So A is the right answer. Okay. Then the answer is there on the screen. I hope you understand what is tailored. Okay. 10. Foreign currency exposure can be avoided by entering into forward contracts, buying at spot rates, arbitrage, none of the above. So please answer. So after this, we'll try to do one more question in the balance time. Okay. So this may be the last MCQ for today. So we will be doing a question now. So please reply your answer for question number 10. Okay, Shikhar has said, yes sir, thank you. I have understood my doubt was sent late, but you had already addressed it. Thank you again. Okay, welcome Mr. Shikhar. And if you require some more explanation, I can offer. Or if somebody wants to again hear that, I'll be answering that. Maybe the next class. Okay, again, we'll discuss that a little bit so that you are all under the same footing. So what is the reply to question number 10? Foreign currency exposure can be avoided by, how can you avoid a foreign currency exposure? By entering through a forward contract, by buying at the spot rates, or arbitrage, or none of the above. Okay, now, the best answer would be A, entering into a forward contract. But of course, you can also buy in the spot rate also, so that you don't have any exposure at all. Okay. But if you want, because now you have limitations. If you have taken a credit period from your supplier, or you're going to get your dollars after some time, then you have to take a forward contract to, avoid your foreign currency exposure. If suppose the time is not the limit, but if time is there, a credit period is there, entering into the forward contract is always the better choice. So let's move on to the question now. Okay, so I'm just stopping this screen here and going back to a question again. Okay, I think some theory is there. Okay, let's understand about the foreign exchange markets. Okay, so foreign exchange market, who are the participants? Who are the people who are there in the foreign exchange market? The first is the bank. Okay, they exchange currencies as per the requirements of their clients. Okay, so these are the people who are buying and selling currencies on the behalf of the clients, or even buying on their own account to make profits for themselves. So then the non-bank entities, that means the multinational companies, okay, they need dollars, or they need pounds or euros, they need currencies to meet their import and export commitments or hedge their transactions. So the non-banking activities, either they require the currency immediately, or they want to hedge their transactions, so they want a forward cover. So these are the people who are there in the market. Then the speculators, the people who either take a long, who don't have any, they are not the importers, not the exporters. They only take a long position and a short position without any underlying exposure. So they want to just gain out of, if they think the dollar will appreciate, so they are going to take a long position in the dollar, and it happens they make money. So otherwise they have no interest whatsoever in any underlying exposure in any kind of a transaction. So their transaction is just to make money. Okay, their motive is to make money. They are only speculators, so they are allowed. Okay, why? Because more people are there. The rate discovery is much better in the futures market or the forward market. But of course, how do you know? Okay, so we do that. Devija, just hold on. So I'll go back to the screen before we wind up. Okay. So then we have the fourth guy is arbitragers. Okay. They make profit from price differential, and we have done some questions also on that, and we have talked a great deal, so it doesn't require more explanation. Then last is the government, through RBI. Basically, they want to stabilize the exchange rates. They don't want a lot of volatility. Otherwise, it can impact the country economy. So they want stability in the exchange rates. There should not be a large amount of volatility. Sometimes, a lot of money is pulled out by the investors from the Indian stock market. So this actually, affects the rupee-dollar equation. So generally the RBI will come in and, either buy the dollars or sell dollars to restore parity in the market. So this is the job of the government. Okay. Foreign currency exposure risk. An exporter who sells his product in foreign currency has the risk that if the value of the foreign currency falls, then the revenue in the exporter's home currency will be lower. Suppose you are an exporter, okay, and you exported some goods outside India, and the time when you exported, the dollar rate was 75. But by the time you got your money, it is 74. So you're losing 1 rupee per dollar. So this is the exposure you have. As an exporter, if the dollar depreciates against the rupee, then you're going to lose out. Okay? Or the rupee appreciates against the dollar, you're going to lose out. Okay. So exporter is always, he favors a dollar appreciation because he gets more money. Okay, in terms of dollar. So, and then he's, at the time when he was exporting, the rate was something, and then suppose it goes down, then he loses money. So there is one question number 5. So how to select a borrow in dollar or rupee. So I think this is also I have covered. So I'll do that again. Okay, don't worry. So I'll not do any other question. I'll just explain this. Okay. Just let me finish one more slide. Okay. An importer who buys goods. Now, importer is also exposed to foreign currency risk. Because suppose at the time when he, imports. So please, Sunil Kumar, please stay at ease. Just listen to my slide. I'll come back very soon to answer your question. Okay. So an importer, he's also exposed to the foreign currency risk. Suppose he has bought certain machines or equipments, or he has imported some raw material from abroad, and the dollar was at 75 at the time when he was placing his order. Okay. So he factored all his costing was done at 75, and he fixed his sale price in India depending that he will be getting 75. But suppose when he paid the money to the foreigner,
students are asking for sharing the screen. Is
screen share नहीं हो रही है?
नहीं, no.
अच्छा, मैं तो कर दी थी. I'll just do it again.
Okay, now it has been shared.
It is there. So I was just telling, we just discussed this slide. People though have talked, but I think most of you have not seen my screen. So we talk about the foreign currency risk or exposures. Both importers as well as exporters, they, undergo a risk. As a exporter, at the time when you exported the goods, suppose the dollar was at 75, but when you bought your money, say after a couple of months, you got it at 74 because the dollar has depreciated. Okay. So, or the rupee has appreciated. So you are getting lesser money. So you are losing out money in your profitability because you had made all your calculations that you will be getting 75 rupees per dollar and your profit has taken a hit. But if you are an importer and you have to pay after some time after the transaction has taken place, suppose the dollar moves from 75 to 76, you are paying 1 rupee more. Okay. Is my slide now visible? Acha, no, I've done it. Okay, fine. So that means the importer is also exposed to the foreign. Now the third people who are exposed to the foreign risk is the fund managers and companies who own foreign assets. So they are also exposed to the foreign exchange risk. Suppose you have an assets abroad, okay, and if it happens that the value of the dollar goes down, then the asset will lose their value. Okay. Suppose you have taken loans from abroad. If the dollar moves from 75 to 76, your loan will become more. You have to return more money to the lender. So, all these people, they are exposed to foreign currency. These are foreign currency risks associated with the market. Okay. Now, in the next class, we will be talking about the translation exposures, types of exposures, translation exposures, operating exposures, and transaction exposure, and we'll be doing some questions from the study material. Okay. So, in the meantime, I'd like to answer this question. Okay. So we will be closing somewhere at this level. Maybe if the time permits after my explanation, I can do something more. But let me address some of the questions which have been thrown by you people. Sir, how to select borrow in dollar or rupee? Please explain in depth. Small confusion of selecting to which. Now, without even referring to this question, okay, I told you, let's do a very simple mathematics. Suppose the interest rate in India is 6% and America is 2%. Okay. So which country should be trading at premium? America. How much? 4%. Okay. So if the rate was 70 rupees spot, now after 1 year it should be 72 rupees 80 paise. So you multiply it by 4%, 70 rupees, you will get 72.80. Okay. Now there can be scenarios where the rupee has not depreciated by 4%. It has depreciated less. This can be one scenario. The second scenario can be the rupee has depreciated more than 4%. Okay. Suppose it is 5%. In both the cases, there will be an arbitrage opportunity. First case, if the depreciation of rupee is less than 4%. So 4% is a no arbitrage kind of a game, where the 72 rupee 80 paisa dollar is a no arbitrage rate. Okay, as per the interest rate differential. But suppose it is 72 rupees 50 paisa. Less depreciation. Only 3.57% depreciation. As against 4% depreciation. Okay. So that means you invest your money in India. You borrow in dollars, bring in India, dollars into India, you will earn the rate of interest in India, which is 6%, you have to pay 2%, and the depreciation will be only 3.57%. You will be gaining around 0.4%. Okay, so this is where the currency is not depreciated fully. Then it makes sense to borrow, abroad in dollar terms and bring that money in India and put in India to work in a bank which will give you a rate of interest of 6%. Okay, so you will overall gain by 4.4%. But let's take that instead of, it has overshot. Suppose the rate is now 73 rupees. Okay, instead of 72.80. So that means that the depreciation is much more, at around say 4.4%. Okay, so in that case, it will be advisable to borrow the money in India. Okay, pay 6% to the Indian bank and convert that money in dollars and put that money at work in US and earn 2%. Okay? So you will have two gains here. One, you have got 2% in US as interest rate. Second gain will be the rupee, the rupee has gone from say 70 rupees to 73 rupees. Okay? So your dollar you are getting more money in terms of rupees. Okay? So which is around 4.5% or so. So you add that to your 2% gain in America, where you have invested your money. So it is about 6.5% and you are paying 6%. So you make about 0.5% or little less than that by doing this reverse of arbitrage. So if the depreciation is more or depreciation is less, if the depreciation is less, invest in India. Bring the dollars will flow into Indian rupees. So people will sell rupees, borrow dollars and invest in Indian rupees and take it back to their home currency in dollars, and you will find you're making money. And if the depreciation is more than, say, the interest rate differential, then you should borrow money. Then the money will flow out of India into, say, America or in the other currency which we may talk. So that means you borrow in India and invest in US. You will make money. So that is the explanation. Okay. So you can just go through the video of today's video, and you will find this explanation has been given there. Latest PPT is not available on the portal. Okay, so I'll just send the latest one also. Okay, fine. So this carries today's explanation will be also there. So I'll give it today to the Institute of Chartered Accountants, and then it will be uploaded. Okay. I hope I've answered all your queries, and I can see if sir, how to round off the amount into rupees. So I'm sharing the screen, so I'll just take you to the screen again. Okay. Are you there? I mean, Divja. Divja, can you just see it? And I mean, this is the merchant rates. It is 75.
Your screen is not coming.
अच्छा ये मैंने तो करी ही है फिर गायब हो जाती है अपने आप. अच्छा I'm just putting that away. Is it visible now?
Yeah. Now it is visible.
Is it visible?
Yeah, sir. It is visible now.
Okay. So if you just see the screen, in this question, we are asked to do round off in the multiples of 0.0025. If you see the merchant rate, which has been calculated as 75.2147. Okay. So I have to round off in the multiples of 0.0025. So it will be 75.2150. Okay. This is in multiples of 0.025. So the next would be 50, last two digits. And if you look at the ask rate, it was 75.3728. And then if I have to, round off to the nearest multiple 0.00.25, then it will be 75.3725. Ashish ji, are you there? Hello?
Yes, sir.
So, Ashish ji, मैंने कर लिया है. I mean, just she was asking about, rounding off to the multiple of 0.0025, which I have answered. Can you, just check?
No problem. I will answer it. Don't worry.
Okay, so you answered my behalf, and then you take it on your mind.
Okay.
And the students are asking about the latest PPT. I'll send it to you because I have added some more examples.
Okay, sir. Can I take over now?
Sure, sir. Sure.
Okay.
1 minute.
So I closed down my this thing. I mute my video.
No. Let it be continue. No problem.
Sure.
Okay, students. We hope the today's session must be very fruitful for you because sir today has covered the application of derivative concept in the context of Forex. So in the earlier class, you must have studied the derivative concept in the context of stock and index. Now sir today has covered the concept of derivative in context of Forex. So there are one student was asking for what is a tailored concept. I think sir may have been replied. But student, I would like to explain here that the forward contract are tailor-made. I just give a very small example. Like for gents, when we go to the market, we want to buy a shirt. Okay, so what is happening? We have a size of say 38, 40, 42 like this. But however, what happened, like in case of me, whenever I go to the market and whenever I want to buy a shirt, normally my standard, my size does not fit neither in 40 or nor in 42 because my size is somewhere in between these two sizes. So in that case, what happens? I have to buy a piece of cloth and get it stitched from a tailor. So my dealing is what I am doing. I am getting a shirt stitched from the tailor. So like this forward contract is a tailor-made contract. They have conduct according to your own requirement. Whereas in a future contract, they are of standard size. So I hope this was clear to you. Now there was one student was asking Divija from column. Sir, if fourth year forward rate has to be calculated, ask an examination, then multiplying interest rate is enough, or is it necessary to show for every year, like in one question? Now, Divija, please note, once you are if the question is like concept of they want to test your concept of interest parity or purchasing power parity, then in that case it is better you show the whole calculation up to the 4 year by year. But however, if this rate has been asked in any long question, so then you know to show the calculation for each year separately. You can straightway jump to the 4th year rate. So it depends on the nature of a question, because say if the question of a 5 marks or 4 marks is there, that they want to test your knowledge of purchasing power parity for the 4th year rate of interest. Now in that case, if you straightforward write the 4th year rate of interest, then certainly you may lose some marks. So it is always better you should see the nature of question and length of the question, what is expected. Now the student were asking that, sir, PPT will be made available. Yes, it will be made available. See student, what happens? The PPT preparation is not a one-time exercise. Even sir used to put some new concepts and ideas in this. So what we have planned, we will distribute the PPT after the class will be over for your revision. Before first, sometime what happens, we deliver the PPT, sir add something. So it is better we will deliver you the PPT after the class. Don't worry about the same. Now there was one common question was asked by the student was about the decimal points. Now see student, in decimal points there is a very lot of confusion, although when I will take up the final session in the end of this classes, I will throw more light on the same. But please note, so far as the decimal point is concerned, you see the quotations. First of all, you see whether there are any instruction have been given in the question regarding rounding of the decimal point. Like in the question, if it has been mentioned that you round off your rates up to 0.0025. So in that case, you have to follow this instruction rigidly. You have no choice. Now, if nothing has been mentioned, so then in that case, first you see up to what decimal points rate has been given. Okay, now it might be possible that rate might be given itself in a up to 4 decimal point. So in that case, the answer is expected in the 4 decimal point. And if the rates has been given up to 2 decimal points, so you can continue to your calculation up to 2 decimal point. But what happens sometimes, like in case of a Japanese yen, the Japanese yen rate is quite, you can say it is a very cheap currency. So its rate can be up to 4 decimal point because it is a very cheap currency. Moreover, like in case of a US or INR, if nothing has been mentioned and the rates has been given up to 2 decimal points, so you can continue for the same. But however, I will will throw the more light when I will take the final session. So meanwhile, you can continue. And if there are 4 decimal point, I am again repeating it. If 4 decimal points quotations have been given in the question, so you have 2 choices. Either you can continue as it is up to 4 decimal point, or you can round it off up to 0.0025, because as per FIDE guidelines, you have to round off the figures up to 0.25. So you can both your answer will be considered as correct if no contrary instruction has been provided to you. So okay student, with this we come to the end of the session, and we shall continue the topic of foreign exchange, this topic day after tomorrow's class. So, and I thank you for the patience listening, and thank you the Pravesh sir for making this session so and participating for the students, that every student were watching very carefully. So thanks a student, thanks a lot, and we shall see you day after tomorrow. Thanks Pravesh sir.
Okay, thank you sir.
Okay. Mr. J. Mr. J. Mr. J. Mr. J. Mr. J.